The whole focus on Atmanirbhar India, to me, cannot happen unless we build an Atmanirbhar financial services for enabling Atmanirbhar India. And this gives us the opportunity to really make this coming decade ours. Now, we all know about what this government has done for Atmanirbhar India. Um, Three Atmanirbhar Bharat packages got announced for over $400 billion dollars. I'm not going to get into the details of that because a lot of the details for that are known. In addition to that, not just the packages that were announced, but let's see the last year, the government has changed the definition for MSMEs. It's boosted the scope of private participation in so many additional sectors, increasing FDI initially in defense and now in insurance. So the government is opening that up as well. The PLI scheme that they have announced. In addition, we saw the fiscal and monetary support that got made available by the government and RBI through the pandemic. You know, the emergency credit line guarantee scheme for MSMEs, on tap TRO schemes. So a lot of openness, a lot of flexibility to really take India out of the current clutches of the pandemic and really set it for a stage for 10% plus GDP growth rate for the next decade. This, I believe, is the opportunity. Naturally, it calls for very strong execution all around. That goes without saying. But it brings us to a very important question that, if you see next year, our GDP growth rate, 11.5% expected, on about a little over $3 trillion currently, it will require a additional capital, or what's called the gross fixed capital formation, of about 33% of GDP. That's what the government talks about. So about $1.1 trillion. Let's also talk about our dream for a $5 trillion economy. And if we were to even say 5 years from today, let's say FY26, that's where we want to get there. What that means is that 11.5% is not just for next year. It has to continue to grow at 11.5% or by and large every year for the next 5 years, which means that the capital formation has to grow at least 13% annually. From about 1.1 trillion for the next year, it gets to 1.7 trillion in FY26. Now, when we look at this, let us look at what's the current rate. The current rate of the gross fixed capital formation is about 27% of GDP. This needs to rise to 33%. So I said, okay, let's look at numbers for our best GDP growth rates. Between 2005 and 8, we were close to a 10% growth rate. And there again, interestingly, the capital formation was around 33%. So to me, it's very clear that we have to be able to get to this kind of capital formation around 33% of GDP, growing from 1.1 trillion next year to 1.6, 1.7 trillion in 5 years' time. If this economy is to chug at 11%, I'm not right now going to get into the discussion around all the policies of Atmanirbhar India. How will they get executed and stuff? That's another discussion. There are many other experts for that. So let's assume that can happen. My whole focus is to do that. Where will India generate the capital from? Now we know that any large economy has a strong domestic financial services industry that ensures that it channelizes domestic savings into productive investments. That's one area. It also builds a strong platform to attract FDI in specific areas that it wants to open up, and this differs from country to country. And it enables a solid set of public institutions and private institutions that can drive this capital to productive uses. So it's a combination of these factors. And there is nothing new in this. So let's look at the Western world. Let's look at the modern economies. We know that our traditionally large Western democracies USA, Germany, Japan were all built on very strong financial institutions that were domestically led. They opened up to the world, but they created a very strong domestic financial services sector. Even a small country like Singapore made a big difference to its economy by focusing on being financially independent. And eventually, it's become a financial hub to the region and probably trying to become one to the world. China has done that very clearly over the last 20 years as well. So they became financially independent before they became economically independent. We've also seen the failures like the East Asian crisis, Southeast Asian crisis 1997, where over-reliance on foreign flows brought these countries down to their knees. And it took them a whole decade to rebuild themselves. So I think it should be reasonably clear from this that to us, to realize the dreams of Atmanirbhar India, we need to build a strong domestic financial services industry. To me, that's the Atmanirbharta in financial services. And let me talk about 5 key levers for building this. Let's first start with our savings rate. Now, our savings rate has fallen actually instead of growing over the last decade from about 38% GDP to 30%. Understandably, because we are still an economy that is spending on discretionary items. As people are getting better and more economically well off, money is going over there. But 30% savings is not a small number. How do we see that amount of money we are able to channelize into productive financial assets so that they don't just get stuck in real estate, in gold? Now, I can again understand that somebody needs to buy their first house. That's fine. But beyond that, what kind of tools are we proactively introducing that can get our general middle class Indian to invest in more financial service products and solutions? The second lever is a discussion on foreign versus domestic capital. And this is something that a country like India needs to actively manage. The foreign capital can and has been actually very innovative and strategic if you think about in the last decade. It has really helped us build our private equity and venture capital sectors. It also got into some long-term projects and some of that got stuck. We must also keep in mind that any money has to get adequate risk-adjusted returns. Foreign capital, we know by definition plays on a much larger canvas just beyond only our borders. And hence it can come fast, but it can go fast. So while we plan to attract and retain it, we must keep in mind the associated risks with it. On the other hand, Indian capital by definition will constantly evaluate domestic opportunities. But sadly, it is still not enough to support a 10-11% plus GDP growth rate, and it will take us time to build it. Hence, a balanced focus on foreign and domestic capital becomes very important. And to do this, we need again a strong domestic financial sector, which includes banks, NBFCs, mutual funds, insurance companies that are both gatherers and investors of capital. And it is really these companies, besides the government, that have the capacity and the capability to manage the savings, whether of the common man, of corporations, and the government, by investing them suitably with the twin objectives of ensuring adequate returns depending on what kind of project, and also it keeps the investment cycle rolling. So to me, this is another important lever. The third one is then what is the role of public versus private sector? Again, when we are talking of financial services, we really need to debate what kind of investments the public sector should get involved in. To me, large national infrastructure projects, those with long gestation periods where private sector can't raise long-term capital efficiently, some strategic investments. These are clearly sectors where public sector gets involved. Similarly, there could be opportunities for the private sector to enter, but they are perceived at high risk or with greater uncertainty. And that's where a well-executed public-private partnership model can work. But other than this, we have to encourage and open up everything to the private sector because they are more efficient, they are more innovative, they are more timely. The fourth lever then, which naturally comes through this, is the role of the public sector banks versus the private sector banks and NBFCs. Here again, the government would do well to clarify which public sector banks it wants to control and make it clear how they will use them. Most of them are listed companies, and this would provide shareholders the needed comfort and transparency. And it's not unusual. Many developing countries have a few banks that they control for their strategic investment needs. But that transparency and consistency is what is important. Other public sector banks, I believe, should be either recapitalized, they have to be professionalized, otherwise you're creating a moral hazard there with capital being required all the time, and eventually they should be privatized. And that's where this government has made some very bold announcements to privatize 2 public sector banks and 1 private insurance company, as you know. This will help public sector banking become over a period of time far more competitive and more competition for people like us. But I can tell you, this will eventually expand the pie and support much needed future growth. And then when you come to private banks and NBFCs, they must be encouraged to grow, but with the right governance and under RBI's evolving supervision system. But RBI must also treat them on a level footing with the other banks, whether it is in the areas of capital access, customer management, supervisory treatment, etc. And we saw RBI taking some small steps in the last year towards this. It's also important that while we need banks and larger and stronger NBFCs to fund our economy over this coming decade, they need to ensure that the use of Indian capital for this must build world-class capabilities through people, products, digitization, data protection, and frictionless customer access. This is not about protectionism. This is about creating the best in world. And the last lever that I would talk about is the need for public discourse. India has a tremendous growth opportunity for which we need to build out a solid roadmap with inputs from various points of view. For foreign capital to become sticky, we have to develop a sense of trust by informing them of our approach to our policies and staying consistent and transparent. For this, we need a broader public discourse, as India plays a more dominant role in the global economy. It will become important for us, and there is an opportunity for very few countries like us to find an Indian way of building our future. This requires a discussion of the best of ideas from the West, from the East, from within, to develop our Indian way. And therefore, Nikunj, to summarize, I'm very confident that the next decade can be India's. But while many things are required, it requires an Atmanirbharta in financial services industry to enable Atmanirbhar India. And what I'm hoping gets developed is a 10-year roadmap that is consistent, transparent, and supportive to all kinds of capital to help us do this.
We've seen a lot of regulatory changes which have happened. Post the LNFS crisis, barring handful of NBFCs, a lot of NBFCs have actually moved into rough weather. There are some NBFCs which are even now struggling to survive. To your mind, what is the issue there? Why do you think so many NBFCs which have ballooned up, mushroomed up, at least in last decade, in the second half of the last decade, now are even struggling? Is it because of the asset liability mismatch? Is it because they were, borrowing long and lending short?
Nikunj, really, there is very little difference between a large NBFC and a bank. It's only what kind of a license you've managed to get from RBI. At least that's something that Bajaj Finance has shown over the past decade. So earlier to that, NBFCs used to be monoline. They used to be geographically limited. They were really a small set of founders, promoters that wanted to do a little bit of local lending. But that has changed, and Bajaj Finance has shown that opportunity. And I see, and a few others have done it as well. And that's why you can see that RBI has come out with some draft guidelines segregating large and other NBFCs as well and bringing them under greater scrutiny. So to me, it is less about NBFCs and banks. It is more about if we have to really take the penetration of financial services pan-India, if we have to make sure that this is available in an easy, frictionless manner to customers, it is available at very low effective cost and in a highly transparent manner, how do you go and build this? I believe the US has thousands of banks. Somebody was telling me recently, Sri Lanka has more banks than India. So forget NBFCs. Whether it's an NBFC or a bank, the whole issue is we need many more lending entities, whatever name you want to call them with. What is also important is there is a learning time and learning curve that each of these entities will have to go through. You can't just throw capital in a lending business. You will get the growth. You won't get your money back. So you have to learn how to build risk models. You have to build a risk culture in the organization. And a risk culture, again, is not about saying no. That's the easiest thing to do. Then you'll never build your business. Risk culture is about getting to know more and more about your borrower so that you're comfortable with the loan you're giving to the borrower. And that takes time. And hence, I believe that we need many more banks. We need to encourage people to start off NBFCs. Instead, I see NBFCs as a learning license to a banking license. You start off as an NBFC, you build it for a decade. If you do well on, by and large, all counts, you earned your right to get a bank license if you want that. If you don't want that, you stay on as an NBFC.
Mr. Bajaj, let's talk about the importance of data. Data indeed is the oil, data is the new oil of at least this decade. Given that one side there is importance of data and how data capabilities is something which Bajaj Finance has demonstrated the advantage of it, on the other side you've got this entire privacy issue which is clearly there. Which way do you think this entire data and the data privacy issues for an NBFC would apply? Because that in a sense now is really the so-called bedrock which will enable NBFCs to grow, and they can really use their data so that they can monetize and they can really reach out to the existing customers.
Nikunj, as you know, our data rules also are currently under discussion and will get finalized soon. To me, as a basic principle, control of personal data should lie with the individual. There'll be some exceptions to this rule for national security and other things, but that control should lie. However, in a country like India, where almost half our population is illiterate and does not have access to financial services, what happens is the cost of going to them and providing them those financial services through the traditional branch route is not affordable. And that's why, even though for those that say we don't need more banks, I ask them, why are 500 million people not getting service then? The reason is that it is not a viable proposition. Technology, digitalization, and data can change that. And what would be an interesting and important thing to do is to create a base KYC data set for the low end of the pyramid for people that are by and large illiterate, which will be available only to sell a set of standard low-risk financial products that the regulators approve to this population. That will make it viable. That will mean that a certain minimum amount of data the government is willing to share with everyone. But I believe that is democratic because that will lead to large-scale financial inclusion. Everybody who's literate, and there are ways to define that, should have the right to decide, at least for financial products and any kind of products, what kind of data to share. The other big discussion clearly is on data storage and security. And this needs a larger and open discussion. A country of India's size very clearly can mandate data localization. But this needs to be debated so that it is done in the correct manner. We know that with the virtualization of data, whether physical data centers are here or somewhere else, people are hacking into it all the time. So to me, it is less important where it's located. Though I must say, because of the fact that we are going to be such large consumers, we can economically set up data centers here. We can probably do it cheaper than many other countries. So I would bat for that. But the security around that is what needs a lot of thought. And that is where on cyber security, we need to build institutions, probably with industry and academia working together to help us build innovations in this area. Because all of this is still happening outside of India. We need to find our own way over here.